we have our diamond sponsor, Quant Mutual Fund, Mr. Sandeep Tandon, who will be
Yes, so he will be joining us for the very first session. So ladies and gentlemen, put your hands together in welcoming Mr. Sandeep Tandon to join us. So he's the founder and MD of the Quant Group and has an expertise of over 27 years in the capital markets. And his journey in the money management business started long back in the financial year 1992 to 93 with GIC Mutual Fund. So he later joined IDBI Asset Management, where he was founding member and was a part of the core team that initiated the asset management business. So and we would like to welcome Mr. Sandeep Tandon with a beautiful bouquet. For that, we would like to invite Mr. Suresh Kupara to join us. Put your hands together in welcoming both of them on stage.
Thank you.
So welcome, sir. Thank you for joining us. Can we join the center stage, please? Yes. So over to the very first session of the day. I'm sure it's going to be insightful. So over to you, sir.
Morning, everybody. Morning. So I thought let's talk about geopolitics thing, which is the most favorite thing right now, and everybody is very anxious to understand that. Okay. I will try to make the session more interesting, giving you perspective how to draw conclusion rather than saying waiting for in the morning to see what happened yesterday night, or try to see what can happen, okay, depending on the developments. So very interesting way of looking data, okay, and a lot of people are familiar, let this graph come, a lot of people are familiar that we talk about concept of predictive analytics, and we have showcased, if you recollect our graphs, we have tried to showcase in 2012 we have written how 2025 onwards things will become extremely difficult for the global market. And the beginning of this year we talked about don't look at the equity market, just look at the global yields, global currency and global wars. You will get the answers, and this is the way phase has played out. We also talked about that second half will be better than the first half, because a lot of question came in the end of December, what happened in September, October, whether 2025 will be a challenging year or not, or it will be normal year. So we talked about that second half will be better than first half, and within first half, first quarter will be the worst. And that's, you have seen how well it has played out for India. And I still believe what we said in the beginning, come December 2025, market will be all-time high, much higher than what you saw in December 2024. Okay, so how are we astrologer to predict that? No. Okay, how we try to capture these data, that is something very important to understand from our perspective. Since we talk about concept of market implied analytics, what analytics, so you have to reverse calculate. Can we predict geopolitical volatility? Answer is big no. Okay. Can we predict crude prices? Can we predict gold price movement? Can we predict silver, copper, or global yields? Answer is yes. Can you reverse calculate and tell you what is the impact? Then you can figure it out. Let's say example, last month fact sheet, we talked about crude. Okay, when crude was correcting, and I have written in the first day of this month, okay, in June itself, that crude will see minimum 10 to 12% rise. Obviously, we didn't have a clue about Israel or this situation will come. And it played out beautifully. What is very important to understand is that if you can predict these asset classes, you can reverse calculate and say a geopolitical event will go to play out. So, okay, so this is the whole thesis. When we in the beginning of the year we saw how would be the yields movement, how would be the currency movement, then we say it will going to be a challenging year. Now question comes, how long it can last. That is very important for understand from a global perspective as well as Indian perspective. The way I look at India, I always say something has changed, okay, which means long-term perspective is great for India. We always talk about, people talk about earnings forecast. This is the next 3 years earning, this is the 5 years earning, or the GDP numbers. Nobody forecasts about the multiple effect. What is the multiple the market should trade? What is the fair value of the company based on the valuation or valuation multiple? Similarly, with the help of perception analytics, we talk about what will be the perception of a country or the multiple of a country. So we have said that something has changed in India and it can last for longer term perspective. We believe that India demographic cycle peaks out in 2047, and multiple data points which we track. We said India will remain expensive till then, which means India is expensive currently. Also, if you ask me, India has done better than the global market in last 1 quarter. Is something has changed drastically or the valuations has become very attractive? Answer is no. More on the relative basis. Yeah, thank you. Thanks. So, I'll just take to one slide and talk about. So I'll spend some few minutes on this perspective. You'll get a fairly good perspective. This slide was prepared in 2012. How you see by 2032, 33 sort of things. Okay. So when we're talking about something has changed for India, which means next 22 years, India P multiple will remain elevated. Okay. So that's the opportunity we're talking about. Now I always talk about in life, absolute numbers are important, but relatives are more important. I'm a student of theory of relativity. Everything in life works on this thesis. And if you understand this thesis, then you have more answers rather than more questions. This is the one big challenge everybody gets into this debate. What is the fair value? What is absolute numbers? Okay, the fair value thesis is absolutely bogus thesis. It can give you some perspective, but does not give you all answer. Okay, and this is something what we have to understand. When something has changed for India, in absolute terms India is good, but in relative terms we are extraordinary, and that is very important to understand, because money shift on relative basis. Okay, money shift from high risk to low risk environment. So if you understand the entire thesis of global liquidity or global fluidity, how it works, and if you combine with that with the sentiment, with the risk appetite, you get answer from a money flow analytics, how money will shift from global market to India. Okay, and that is the entire thesis which I am going to talk for a few minutes. Very interesting aspect is that as we are entering into this phase of turmoil globally, okay, and important to understand this picture which we talked about in 2012. Let me showcase a few things. So we were in 2012 when we wrote this, and what is this picture is all about? This is all about x-axis, is only about how geopolitical volatility will move on. This entire thesis is on geopolitical volatility, and you see N19 we say it become red, and becoming red here and becoming more red here beginning 2024. Okay, and then it fades from 30 onwards or 33 onwards. This phase down significantly, which means a geopolitical volatility will come down. And what is important, what could be the outcome of this? Okay, it's easy to say this is the way it will happen. How it will affect us? Very interesting data. We were here when we wrote. So if you look at his own track record, 2015 we talked about currency war. August 2015, China used as a yuan battle, which were depreciated sharply. This was played in August. Disbelief rally played out in whole 16. 17 or somewhere in June, July, I think DM peaked out. EM peaked out in 18, it happened. India peaked out in January 20. Market busted, global market bubble busted in 2020. So if you really look at, and then we say in this red phase, what will happen? Cyber war, biological war, economic war, deteriorating weather condition, highest ever inflation, interest, crude rate, wheat prices. This is what we talked about. And very interesting thing is that though the geopolitical volatility is marginally decay has begun, but this becomes red. It means maybe volatility started coming down, but it has its own sweet impact. And this is where I am coming from. Let's understand market from a global perspective for 2 minutes, because global risk appetite, okay, which is the sentiment data for global markets, particularly US, which is like 64% of the global market cap, that cycle has peaked out. Okay, European cycle has peaked out much earlier, risk appetite has peaked out, which means entire developed market risk appetite sentiments has peaked out from a longer term perspective. Coming back to the liquidity aspect, again global liquidity. In last 4 years, we saw extraordinary liquidity coming to the US market. From across the world, people moved to US and the technology stock. You have seen the skewness in the Nasdaq, and we all know what sort of wealth got created there. Now purely from liquidity perspective, across the world, money has shifted. Even that cycle is peaking out. So when you have this combination of risk sentiments peaking out, liquidity peaking out, that is the peak of a market. So I expect either global market has already peaked out or will peak out very soon. Okay. So for us this month, these numbers are not very important. For me, what is very important is the relative. Where we stand India on the relative picture. Okay, if that cycle is peaking out, at least emerging market countries, particularly Asia-centric emerging market I talked about, whether it's talk about Indonesia, India, or few more countries, are the biggest beneficiary. So if you really look at India emerging market or India risk appetite significantly low, good liquidity or productivity is actually rising in India. Okay, and if I look at from a relative perspective, what is happening to US, we are in a very comfortable situation. So if you notice, in last few months or particularly this year, beginning of this year, the global risk appetite peaked out and money shift came to India in some manner. Same FIs who sold stocks for last many quarters are coming back, despite market has not corrected. What has changed? Suddenly India looks safe. This is the only perception which has changed in the mindset of a foreigner investor, and that's very important. That's the reason I say you have to look at on relative aspect also, because money shifts from relative basis, it doesn't shift on the absolute basis. This is one thesis. If you can learn and understand, you will get more answer. The most important aspect to understand is that how long this cycle can last. One is obviously till 47 we are talking about India in a great situation, but given the turmoil also, if we are showing the cycle has potential till 2032-33 will be a challenging phase of the market, then obviously this question comes whether it is safe to invest in the equity market, whether we should move to debt side of the market. And when you're talking about extraordinary inflation globally, our US forecast, a lot of people will surprised, we have written already in the book last 2019, it will be 9% minimum, 10-year yield will be heading toward that. But it's not happening tomorrow morning. It's happened by 2030-31 sort of period. So it's not happening that and it's a gradual move which is coming. What is very important for us from India perspective, which I want to talk about. So we have already talked about earlier that 2025 will remember as a period where dollar index cycle will peak out. The relevance of dollar will start declining, and we wrote in 2012 how this phase will play out. And that cycle has come, and we also simultaneously talk about how the India can be decoupled. Okay, so it's when you look at from longer term cycles, we do get answers. 2 months back, and if I'm not wrong, in March fact sheet, we have written that India decoupling process has begun. So when time comes closer to that event, we tend to highlight what has changed. So India decoupling process has already started, and that's the reason if you're seeing, despite we have Indo-Pak tension, we have Middle East crisis going on, we have seen trade wars related challenges or term tweets which is coming on regular basis, market has not impacted at all. Small correction intraday for 1 or 2 days and then again market rallies. Doesn't look like, if you look at global markets, there's no impact. So let's also understand, I will come to that point also, that India is relatively safe, and this is what in last few months at least data points is showcasing that our thesis is working well, which means as compared to anybody is looking for US and other global market, a lot of people get very excited with the US market. In the past it was great. My biggest worry is US market. Okay, if you ask me what can go wrong now, vulnerability in US is highest. And I will not be surprised if next 1 quarter you will see extraordinary volatility in the global market, particularly on the US side. So worry is US, not India. Obviously, if somebody is going to vomit in US, you might see a stink out there here also, and that's the way market will impact. What is critical for us to understand in this cycle how currency will behave. Historically, we have always said that in any analyst or strategist chart book you look at, he will talk about 3 to 5% depreciation in currency, 3 to 5% depreciation in crude. That's a standard thing because over a period of time it has happened. Now this is important to understand. When we say the dollar cycle is peaking out, the relevance of dollar is going to go away, relevance of US is going to decline, it's not going to collapse, it's going to decline, which means emerging markets are coming back. And the emerging market cycles are bottoming out. My personal sense is that either rupiah has already peaked out, and we have written in the book it's about 90. In 2019 we touched these levels around 90, and in the forward market, in the ETF market, we have already seen 90 levels. So either rupiah has already peaked out, maybe at best it will peak out by September or so, which means from September 2025 onwards, again we are not astrologer to tell you the dates, this is largely from the cycle perspective. We can say the reversal of dollar has started, which means rupiah is going to appreciate. It's not going to happen tomorrow morning, but over a period of time, if rupee appreciate by 30% in the next 6 years, don't be surprised. And that will make huge difference to the confidence of the economy. It will make a lot of difference to the flow which is coming. So people talk about India will be 10 trillion economy. Answer is yes, one day it will happen. People talk about JP Morgan, Goldman Sachs, all 32, 33, 34. But if our thesis is right and rupiah appreciate by this much, it will, at least this period will be shortened by at least 3 years. So that's the way, because everything we measure globally in the US perspective, that $10 trillion, not in rupees terms. Rupees terms it can happen even much earlier. What is critical for understand in very simple manner, how does it affect us? How it affects our portfolio, how it affects our thinking. So important point is, India is relatively very safe. And even I have to talk about, forget 22 years. Let's just focus on next 5 years, because 22 years is a longer period. Next 5 years, if we want to see a visibility or perspective, then definitely we can say with huge amount of confidence, next 5 years is going to be good for India. Okay, both in absolute term and relative terms. Why I talk about relative? Because margin of safety India will be much higher. And this is something we have to understand. Why we always harp on the thesis, why US will going to correct sharply, or relevance of the dollar will go, relevance of US will go. Because if you go back in this history also, and I'm talking about few centuries data points, how the currencies market, like whether you talk about Spanish currency or Franc thing or even Portuguese currency, they were the reserve currency. A lot of people are not aware of that part. But if you go back and the cycle and look at it, 86 to 105, 6 years in that cycle, the 96, 90 years cycle is there from the currency point of view, which means dollar as a reserve currency should also peak out by that thesis in similar timelines which we are talking about. What is critical for us to understand, this can be very nice academic debate. How does it affects us? It affects us because we will attract massive flows. Because from entrepreneurship perspective, India is the best place in the world, significantly better than China also. And when everybody is worried about global tension, global geopolitical thing, people will come for India, A, from a stability point of view, B, from a scale perspective. Both stability and scale, I think India can offer. So the entire thesis with Mr. Modi talk about manufacturing as a base, or India as a re-emergence thesis, we are completely believer in that thesis, not from the current country's PM is talking about, just to endorse that. Based on our analytics, we have been showcasing these theses for a while. Just 1 second. Can I get a bottle of water? Coming back to the, instead of looking at longer term perspective, from a very near term perspective. So, beginning to mid of 2024, we were very early to talk about that India risk off cycle is begin. We could be the only team who talked about India is the high frequency data is saying something is not right for the Indian economy, and as a risk off phase begin. And by December 2024, best of the strategies downgraded India. We were very early to talk about again in January, mild risk on for India, and By March, we said it's a risk-on rally. Now let's understand where we stand. India is still a risk-on rally. Globally, it's a risk-off environment. Except if I have to look at last 45 days, 60 days, yes, global liquidity is also risen, and that's the reason we have seen a sharp comeback in the global equities also, because overall equity cycle has been slightly constructive. But if I have to look at from the next 3 months perspective, India is relatively safe, vulnerabilities in US, globally risk off, India risk on. And how you play this from a portfolio perspective, largely India centric. So the entire portfolio is towards large infra names, materials up to a certain extent, hospitality space. The only segment, power is obviously a thesis, only space which we are bullish is still the pharma, and that on the generic side, because there is no substitute for India generic from a global perspective. So that's the area, if I would like to keep a bet, that's the area which I like to be more optimistic. One more data points I want to share with that part. Recently, SEBI has started giving SIF license. We've been lucky to get to the initial stage itself. What is very important for us now as a distributor fraternity, you have to understand, it's a great product from a diversification point of view. Because we all, though regulator also said that, and we agree it's meant for high risk appetite, but statistically or mathematically, if I say, it actually reduces your risk. Globally, prop trading or hedge fund are superior products. In India, we have negative connotation. You say the moment you say prop trader, hedge fund, people start looking from different perspective. But if you look at purely from a statistical measures point of view, overall portfolio beta or standard deviation, and any risk matrix which you look at will actually come down. So as a fraternity, it should be a great opportunity if you can understand the product, get the certification done what was required, and look for a both mutual fund and the SIF route together. It will be a far better proposition for your clients rather than just looking at the long account product, because yes, SIF can underperform if you are in decisive bull run. Okay, and SEBI also does not say that you have to be running a short portfolio all the time. It is the option given to you. So in risk on, you may not run it in any manner, but in a risk off environment, if you want, if you are bearish, let's say in January 2025, we were quite bearish on the Nasdaq, and we have multiple channel. I said I expect US to correct by 15 to 20%, Nasdaq particularly by March, and it could be a alpha generating opportunity which could be there. So if I have to look at from a larger perspective, it's a great opportunity to participate. Please understand this product. I think many AMCs are spending time and energy in educating about this space. We will also start a lot of things on the education perspective, because we think we should be in the position to launch that product as soon as we get the set approval from SEBI. We are completely ready for that. Very important, don't look at this, the risk number. A lot of people, we get question, is the risky product? It is absolutely not. I'll give you a very small example to explain you this thesis. What the product talks about, additional flexibility of 25% shorting, which means you can short 25% or you can take naked 25% exposure. Now a lot of people get worried. If you are short 25%, can you lose your capital significantly? First of all, anybody runs global long short book. Risk management plays a very important role, and the risk management is very important out there. Some people who run high frequency, they have intraday limits. People who are short-term trader have a weekly limits also. When looking at the long short guides, people do put at 10, 12, 8% sort of limits, or on the trailing basis also. What is important to understand, what SEBI has said, that the gross exposure cannot be 100%, more than 100%, which means if you are 100% long on the market, and if you want to exercise 25% naked short option, you have to bring down your long exposure to 75%, then only you can take 25% short. So which means by default or by design, if you are taking a short exposure in the market, your long exposure comes down to 75%, and if you take net impact, the net exposure comes down to 50%. So one is important, the moment you exercise this option, your risk actually comes down. Second thing, let's understand the worst case scenario. 25% book is naked short for you. Okay, and assuming that entire position, all your stocks are down, let's understand how much you can lose. Okay, as a house, if I say that we follow at least 10% in terms stop loss from a risk perspective, from a trailing perspective, will not allow more than 10% risk. And a lot of people are worried, okay, if what happens, stock becomes 20% down, 30% down. Obviously, if you can only hedge the derivative stocks. Derivative stocks are very liquid. We are still not very clear, can we borrow and short? In the lending program, can we borrow and short? We are still not clear on that front. But if you assume it is only the futures market, then it's very, very liquid. And assuming the entire 25% position, you have a book a loss of 10%, you may lose 2.5% of the capital. But it's a very rare phenomena which will happen that entire 25% of your baskets are short. Obviously, you can't be more than 10% short. That's the limit which is there already in place. So it's important to understand how well you can capitalize this opportunity. I think it's a very unique opportunity. I think regulator is very forward-looking and giving this opportunity. We started with 25%. I will not be surprised it will be 50% in the next 5 years' time. And that's the way in the derivative market also. Initially it was not allowed, and I used to be broker and was a large player in derivative market. We met regulator and say hedging should be allowed. It started with 20, became 50. Now technically 100% hedging is also allowed within the mutual fund space. Here, hedging option is anyway available to you. What is important? Naked short position, which could be alpha generating opportunity also. It's not only the risk, you can make alpha out of it, and that is the whole thesis. So you have luxury to exercise that option, not a compulsion to participate. Thanks a lot.